We've been tracking Quiver Quantitative's institutional holdings data, and we've noticed that many asset managers and hedge funds have increased their stake in Eagle Materials, which could signify an important change in the housing market. Firms such as Exodus Point Capital Management, Alyeska Investment Group, and Vanguard Group have all added to their EXP positions recently. Most notably, Vanguard Group increased shares held by 2%, bringing their total EXP holding to 4,072,799 shares at a valuation of around $774 million at current market prices. With this in mind, we took a closer look at why so many investors might be bullish on Eagle Materials. Eagle Materials operates within the construction and building materials sectors, meaning that it is levered to the US construction industry, an industry that might be heating up for a boom according to recent US home building data. Existing home sales are down due to limited inventory, and home prices have been pushed to their highest in a year, with unsold inventory sitting at a very low figure of 3.1 months of supply, compared to 4.5 to 6 months supply often seen in balanced market conditions. It is becoming increasingly evident that there is a major need for more home construction, directly benefiting Eagle Materials and the rest of the building materials industry. In fact, the June median sales price for existing homes was $410,200, according to the National Association of Home Builders, the second highest price of all time. Eagle Materials is a leading manufacturer in light building and heavy construction materials in the United States. The demand for their products is cyclical and seasonal, depending largely on economic and geographic conditions. However, their products are distributed across many geographic regions and markets, giving them regional economic diversification. Eagle Materials strives to be a low-cost producer in each of the markets that they operate in. The company sells construction materials that are basic necessities, meaning that the lowest-cost producers are able to maintain higher margins, better returns, and stronger free cash flow generation. Management understands that price is the main driver of competition in the markets that they operate in, so they are regularly reinvesting into their production process to lower the cost of raw materials and resources needed to create their products. This allows the business to operate with higher brand recognition and lower transportation costs, a major factor that reinforces their low-cost producer competitive advantage. Additionally, Eagle Materials chooses to operate in attractive markets and diversify their regional footprint. 70% of their revenue comes from 10 states: Colorado, Illinois, Kansas, Kentucky, Missouri, Nebraska, Nevada, Ohio, Oklahoma, and Texas. These states are chosen because of their strong population growth prospects. The population of these states is expected to grow 10% from 2020 to 2050, as compared with 7% in the rest of the United States. Through stringent return on investment objectives, reliable free cash flows, and a strong balance sheet, the company plans to consider acquisitions and organic growth prospects. Since 2012, Eagle Materials has invested $2.2 billion into expansion into the heavy materials sector, doubling their U.S. cement capacity and making them the largest independent U.S. producer of cement. Additional competitive advantages for Eagle Materials include production flexibility, substantial owned raw material reserves, and a proven management team. First, they're able to change production levels depending on demand downturns and rebounds, allowing them to operate at a very efficient scale. With 25 to 50 years of primary raw material reserves in all of their facilities, they're able to control the cost of their resources and protect themselves from large swings in commodity prices. A strong management team is a huge competitive advantage for Eagle Materials. Management prioritizes initiatives that will return value to the shareholder, spending billions of dollars in the last few years on dividends and share buybacks. Not to mention over $1 billion spent on acquisitions and organic capital expenditures that indirectly return value to investors. Additionally, management and the board own around 1% of shares outstanding, around $60 million worth of shares. CEO Michael Hawk alone owns almost $20 million worth of shares. As we can see, management is not only excellent at capital allocation, but they are incentivized to return value to investors since they have a pretty large stake in the company themselves. Eagle Materials is a very efficient business. It operates at a return on invested capital of 23% and return on equity of around 40%. With a WACC of 9.4%, Eagle Materials has an ROIC to WACC ratio of around 2.5x, a relatively high ratio that shows how the business is able to achieve returns significantly higher than its cost of capital. Taking a look at Eagle Materials' income statement, we can see that they have some stellar growth in revenue, gross profit, EBITDA, and EPS. Since 2014, Eagle has grown its revenue and gross profit at a compound annual growth rate of 10% and 15% respectively. The relatively high gross profit compound annual growth rate can be explained by expanding gross margins. In 2014, Eagle Materials operated at a 20% gross margin, and now they operate at an LTM gross margin of 30%. Additionally, Eagle has been able to grow their EPS and EBITDA since 2014 at a compound annual growth rate of 20% and 13% respectively. Looking at their balance sheet, we can see that they're a highly leveraged business as well. With around $15 million of cash and cash equivalents on hand compared with $1 billion of long-term debt, we can see that Eagle operates at a high cash to long-term debt ratio. But this is normal for companies operating in the construction materials industry where capital-intensive investments are common. Finally, we look at the cash flow statement where we see some stellar growth in free cash flow and net income. Free cash flow and net income have grown at a compound annual growth rate of 16% since 2014, which can be largely attributed to expanding free cash flow margins. Looking at valuation metrics, we can see that EXP is currently trading at a reasonable price for the growth that you can expect as a shareholder. Essentially, Eagle Materials would have to grow its earnings at a compound annual growth rate of around 7% for the next several years, which to us seems very attainable. Additionally, with analysts projecting a long-term growth rate of 14%, we can see that the company may be trading at a low valuation relative to its future earnings prospects. With improving macroeconomic conditions and slower rate hikes from the Fed, we believe that margin expansion is possible as tailwinds from the booming US home building sector drive increased demand for construction and building materials. But what do you guys think? Check out Quiver Quant to learn more about EXP, subscribe for more videos, and thanks for watching.